Hello and welcome to Options Guide TV. My name is Brian Overby. I am the author of the Options Playbook, and I will be your host for about the next 25 minutes here on Options Guide TV. Want to let you know that we are interactive. This is live using live markets. So if you do want to participate in my reindeer games, please feel free to either log in via the Tradier hub, hub.tradier.com. And you can ask questions directly through that venue, or if you're in YouTube and you're logged in, you can also use the chat box to ask questions. And then if you're on x.com, hello, but there's not much you can do as far as questions are concerned. All right, so I'm going to do a very quick review of the SPX trade, and I was struggling with the graphic on Monday's show. And there was a simple solution, but it took me just a minute to try to figure it out. I might actually show you that. But with that said, what we have going on so far, so good. We did a bearish butterfly in the SPX. And then on Monday, we adjusted the trade. And now we are in a short spread. And so the short spread is based off of where our short strike was in our butterfly. So we're currently short 156.75 put in the SPX and long 156.65 put. No, 55 put. And we executed that trade for a net credit of $4 when we did our roll of $4.10. We put on our initial trade, our initial butterfly was $2.75. So we have a net credit in the account based off of our trade, and we need the market to stay above 56.75. And right now it's at 54.30. All right, so let's put the trade in 56.75. So right now we're looking at the September 27th expiration. We have the rest of the day today, all day tomorrow, and all day Friday before this trade is done. We are actually one standard deviation away, which is kind of nice that the options grid actually highlights that one standard deviation move. And here is the position that we are currently in. We have sold this one, and there we go. 56.55. Yep, that makes more sense. Okay. So 56.55. 56.55. We sold that one. And this is our current position. And we go 15 points down and we buy this one. All right. So if we send, this is now trading for 90 cents. So we're totally up on the trade. So here's one way to look at it is we put the trade on. We paid $2.75 for the trade. The market went against us. We came back and adjusted the trade and brought in a $4.10 credit. So 410 minus 275. We got $1.35 net credit to the account, but we have exposure. We are short a 15-point wide put spread that wants the market to stay above 56.55. But right now, that's currently trading for 90 cents. So if you were just paranoid about the market, you could get out and make 45 cents, and our adjustment was wonderful as far as that is concerned, that straightforward. So our adjustment would work. If you want to try to make a little bit more, we're more than a one standard deviation move away. We're at about a 10 delta. I don't mind at all waiting for today. I would maybe close it out tomorrow, halfway through the day or whatever. But Wednesday to Thursday, there's usually a large rate of decay in the SPX options, and then it just goes exponential as far as time decay is concerned. obviously going from Thursday to Friday. But you see there's still $3 left in premium in this option contract, which is, a bit of juice. And it's mainly because it's a $5,700 index. So with that said, that juice kind of sticks around. From Wednesday to Thursday, it drops precipitously. And then on Thursday to Friday, then obviously it's got to go to zero if it's out of the money, because there's no life left in the contract and you're at expiration. So I just was going to show you this on the what if calculator. So the other day I was in the calculator and I kind of screwed it up a little bit, and I was just trying to zoom in, and I wanted to show that here's what you got to do with the auto range both axes. Instead of a reset button, which is what I was actually looking for, I remembered this, but I had forgotten it during the show, and you just click that and you go right back to where you were. So once again, you move this over, you want to change it back, you go zoom range and you come back, and then you're right back to where you started, which is important if you do something like I did on a live show where I totally screwed up the graph by clicking in the wrong spot. All right, so that was our trade. So that's where we're at. So this adjustment is working out. It looks beautiful as of right now. As a matter of fact, we saved ourselves on the trade. We were $1.35 is what we got. Right now going on, we have a margin requirement of $1,500. That's what we could lose if the market tanked and went below 56.55 and got all the way down to the 56.40 area. The maximum that we could lose on the trade is $15 minus that $1.35. But we look at it right now, the market has moved with us now to the upside. Since we did our adjustment on Monday, we could close it out for 90 cents at the midpoint and make about 45 cents on the trade. And then we would succeed in our goal that we don't want to cheese anymore. Just let me out of the trap. The adjustment worked and we actually were profitable. We could go back to the next week and do it all over again if we'd like to on this trade. So I really like this whole scenario. If you're bearish on the market, which I'm still leaning a little bit more bearish going into October, all the way up until we get to the November election. If you just want a general outlook of the marketplace, that's the way I would kind of look at the markets. October is always seasonally a little bit more of a scary month than most of the calendar months in the year. So putting a weekly bearish butterfly on, and if the market doesn't do what it's supposed to and go down to our short strike on our put butterfly, well, then we adjust it, roll into a short put spread, and hopefully we make that adjustment. Like I like to put the trade on Monday and make the adjustment if needed by Wednesday. And then from Wednesday to Friday, we just hope that the market does not come down and make us get out of the trade. Those are the three scenarios that are with that trade. Now, just looking at some charts and looking at some charts, just saw an interesting trade in XOM, which I talked about on a different podcast. But let me scroll in here on XOM. I want to keep this area right here, and there we go. Okay, so what has happened in XOM, and just, well, ExxonMobil, I should say, the name of the company, and also what's going on with just the oil prices in general. They've really, if you notice, gas prices are fairly low here in Charlotte, North Carolina. They're actually under $3 at this point in time. And that's because oil just cannot get any momentum whatsoever on the barrel of oil. It's really stuck right around $70 a barrel on the futures market. It hasn't really moved from that. And it seems to, if anything, the path of least resistance is lower as far as oil is concerned. Now, as far as ExxonMobil is concerned, if we look at the stock, here was, a gap down in that underlying, right around that 117 level. We came up and we bumped up against that level, and now we've came back down off of that level. So showing a little bit of a bearishness. So the one thing, though, that really grabbed my attention is right here, the 120 level. If you look at that level, going all the way back to April, we see that's where we finally broke out below that 120 level, right? We hung around there for a while, kind of topped out at that level, and then boom, broke through it. and it's came back and touched it 1, 2, 3, 4, 5, 6 times or so, and just for a second, right? But it doesn't seem to be able to come back to that level. So to me, bearish in the space, in particular on ExxonMobil, based off of the most recent price action. And then you throw in this solid resistance level to the upside that the stock just can't break through, and it screams to me short call spread. So we're going to set that one up for today, and we're going to go a little bit further out in time. One of the things about ExxonMobil is that it trades historically at about a 20% volatility. Excuse me. October 29th is their earnings, and we're going to run into the earnings season here shortly. Let me grab a small drink. We're going to run into earnings season, and we're going to hit a lot of stocks that we talk about that are going to have earnings. But October 29th is that earnings. I don't want to really mess with that. I think I'm going to do the 18th, which is the normal monthly expiration in ExxonMobil. So October 18th is the one we're going to shoot at. We're going to go 23 days out. We're going to click on this, and we're going to try. The 120 went down a little bit on me. 76 cents. Well, let's go out a little further. Mainly because the market is down today, $1.45 on the day. So it's working out since I did the trade. Yeah, we got to go to October. We're still going to avoid that earnings. And you can see a little bit of a spike in implied volatility. You're at 20 here, and November 1st, you're at 21. Then you go to 23, 22. So implied vol is starting to creep up after that earnings report. But right now, we're going to avoid it. We're going to do the October 25. We're going to be 30 days away. We're going to sell the 120, and we can get a buck for that. So that's not too bad. Okay, so we're going to hit this bid. Let me clear this out. Hit the 120 right at that resistance level. And then we're going to go down and buy. Let's do the 123. We're hitting the 120, buying the 123. So we can get this done for a net credit at 80 cents. So that's not too bad at all. So we're 3 points wide. Selling this for. I'm surprised that we're getting that amount. But I guess if you work the midpoints, that's not bad. 80 cents. Yeah, I like this trade even more. Okay, so here's our trade. In ExxonMobil, this is going to be the official paper trade. We're going to go out 30 days in time. We'll take a screenshot of this, and we will adjust the trade if we do get the market start approaching our 120 level. But you saw the chart. We feel fairly confident about it staying below that 120 level. At least it's really struggled all the way going back to April to get to that level. So we're going to sell the 120 strike call option and at the same time buy the 123 strike call option. That'll give us 3 points of risk. But we're going to be able to get this done for a net credit of 80 cents to the account. Well, it's already moving. We're going to say 80. We were right at 80. At 80 cents to the account. And that will be our maximum upside, would be $80 for every 1-by-1 spread that we do. Our maximum risk would be $3 minus that $3 minus that 80 cents, or $2.20. That would be our max risk on that trade. So let's send it to the what if calculator. And if we look at the what if calculator, we see here that from 115, where the market is at, our risk doesn't kick in until we hit 120. 123 is where our maximum loss is at. Based off the midpoint right now, that is looking like $2.36. But if we got it done for 80 cents, I guess that's going to be aggressive. And I think 60 cents actually makes a little bit more sense to me, because I was a little befuddled by the fact that it was actually 80 cents. So let's be fair. Let's look at 61 cents, and we'll make that our paper trade for the day. I might put it in at 65 and let it sit there for a little bit. But 61 cents, I'm pretty sure we could fill at that price, which is fairly close to that midpoint. And that's going to be the paper trade for the day. Very straightforward as far as options are concerned. I don't see any questions in the chat box. So that's going to be it for this edition of Options Guy TV. Thanks for stopping in. We will keep an eye on the XOM trade. I do really like, based off of the chart, what's going on in XOM and just in general being a little bit bearish on the industry. And we'll see you this coming up Friday for the next edition of Options Guy TV. Thanks for stopping in.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.